Hi, I'm Dan Danford. We're doing a series of podcasts called Money Made Easy for DadsDivorce.com. We get great questions from our viewers of the website, and I try to answer the questions. Great question this week. When choosing which companies to buy stock in, what should I be looking for? What are some steps I should take to research a company? Wow, there are 1,000 books on this subject. And it seems so easy, but in fact, it's pretty complicated. What I'm going to do is share just a couple of things that I have found that I think are pretty general, but may be helpful to you. They're kind of typical mistakes that people make. And obviously, we aren't going to do in 4 or 5 minutes today what entire volumes try to do at the library or at the bookstore. But these may be helpful to you. The first thing I tell people is try to distinguish between a great company and a great stock. People assume that they're the same, but they really aren't. The reason I say that is you can take a great company like Coca-Cola or popular ones when I work with my students. They always want to talk about Harley-Davidson or Anheuser-Busch or whoever. They're popular names that they know and that they like, and they know they're good companies. But what I equate that to, what works as an example, is a house. Let's say that you have a house sitting on a nice corner, and we all agree that it's a very nice house, and then we're trying to decide whether to buy that house. Well, let's say that most of us get together and we look at that house and we say, you know what, that house is worth about $100,000. That's the consensus among us about the value of that house. Now, everybody agrees that it's a great house. Okay? If you have to pay $150,000 to buy that $100,000 house, then that's not a good value. It's not a good buy. By the same token, if you can buy that house for $50,000 or $75,000, then you got a great buy on what everybody agrees is a great house. Well, the same thing's true in the stock market. Coca-Cola is a great company. Harley-Davidson's a great company. But the price of their stock in the market doesn't always make them a good stock to buy. If they're selling at a price that's way higher than what the intrinsic value of the company is, that's probably not a good time to buy that. It's not a good stock today. Same thing's true the other way, is sometimes there are some distressed companies that aren't great companies, but you can buy them at a really good price compared to their intrinsic value, and that would be a good stock. So I guess what I'm saying is try to separate the two. Just because you recognize the brand name and like their products doesn't necessarily mean it's a good time to buy that company. It may not be a good stock. The best way to approach it is to get unbiased research. Now I'm going to give you a couple of names that I think are helpful. Probably the most famous in terms of choosing stocks is a company called Value Line. And you can subscribe to it. It's very expensive, but you can also go to most libraries and find Value Line. Another one that's very well known for mutual funds but also sell stock information is Morningstar. And a great deal of Morningstar data is available online. You can either subscribe to it or there's a lot of it that's free. The reason I like them and recommend them is that they aren't selling stocks. They are companies that just provide research. In other words, they look at the analytics and they come back and they say, okay, we think this is a good stock or not a good stock based on the numbers and not based on somebody trying to sell it. Because the truth of the matter is, when you talk to a stockbroker or you watch CNBC on TV, or even if you read magazines and newspapers about stocks, many of those stories are designed to sell a particular company or stock. They're placed by public relations firms that work for the stock brokerage firms or work for the companies themselves. And I'm not saying they're deceptive. I'm just saying that the purpose is to make them sound good. The good thing about using somebody like Value Line or Morningstar is you can look past that. You can just look at the numbers and you can read genuine research analysts' suggestions about those particular companies. Another thing I'd say is to be very cautious about responding to news. We all turn on our TV, we all read the internet, we all see bits of information. And sometimes it's tempting to hear that bit of information and say, oh my gosh, if that's happening to, say, Ford, then maybe I ought to buy stock in General Motors or whatever it is. The reason why you have to be cautious is that you have to realize that by the time you've heard that information, so has everybody else. So it's likely already reflected in the prices of the two companies. But more importantly is that the big money already knew it anyway. Okay, not because of insider trading or not because they're smarter than anybody else, but because they have full-time analysts who spend 50 hours a week just looking at such things. Okay, so they're probably going to catch on to whatever trend is taking place well before it gets into the popular media or the news for you and me to hear about it. So it's not that you can't make some money by trading on news and having good instincts, but chances are you probably aren't going to because somebody else has probably acted on it. And the last bit of information that I'll share with you, and this is critically important, is that it takes about 15 or 20 different stocks to build a diversified portfolio. Now, I'm not going to go into a lot of detail here, but the truth is almost any company is very vulnerable. So if you own one stock in one company and some bad bit of information comes out or a lawsuit is filed or a regulatory change happens, whatever that is, it can really hurt the value of that stock. So if you take all your money and you put it in one company and something happens, you could lose 50 or 60% of your value practically overnight. That is very high risk and it's intolerable for most people. So the way to fix that is you add a second stock. So now you have two companies. If one happens to one, likely the same thing didn't happen to the other, so you're protected on the downside a little bit. Well, that particular risk, called security risk, decreases with each additional stock you add to your portfolio until you get to about 15, 16, 17 stocks. And at that point, you have virtually eliminated that security risk from your portfolio, or at least you've moved it as low as it can go, I guess is what I'd say. Now, the reason why that's important is because there are a lot of people out there who are kind of hobbyists who like to study stocks and they like to pick and choose and move in and out. But it becomes a lot more complicated when you have to follow 15 or 20 stocks. I mean, it's not that tough to follow all the information on 1, 2, or 3 stocks. It's pretty tough to follow it on 15 or 20 stocks. And that's why, truthfully, mutual funds have become so popular. Most mutual funds have a rule in their portfolio management scheme that says they can't have over 5% in any one stock. If you think about that real quick, it means that most portfolios have at least 20 different stocks. In other words, that one mutual fund has already accomplished that portfolio for you that has all those different holdings. Not that I'm against you trying to manage a portfolio, and I'm not suggesting you can't do it. I'm just saying it's very hard when you look in that 15 to 20 stock range and you're having to evaluate those all the time. There are a lot of moving parts. So in any case, I hope those 3 or 4 big key ideas are helpful to you. Again, I'd suggest that you go to the local bookstore or library, check out a book. There are a number of different books that are very good on this subject. The more you know, the better you'll do. That's it for another week of Money Made Easy. We'll see you next week. Thanks for asking.